From New York City worldwide for our viewers, I'm Scarlett Fu.
And I'm Michael McKee. Jonathan Farrow is off today.
With 30 minutes dedicated to fixed income, this is Bloomberg Real Yield. Coming up, Jeff Gundlach joins a chorus of investors saying the time to reduce risk is now. Plus, Elon Musk brings his charm to the debt market as Tesla looks to raise $1.5 billion. And new U.S. inflation numbers for Fed Chair Janet Yellen to chew on. Where does that leave the central bank now? We start with the big issue, nerves gripping the market.
The reach for yield is apparent in every asset class.
We know the insatiable chase for yield continues.
We should be watchful for, I think, excesses or buoyancy getting to a tipping point.
It doesn't surprise me that this sort of hunt for income or thirst for yield has reached into the high yield markets. At the end of the day, you've got to take a step back and say, am I being fully compensated for the risk that I'm taking on?
Bond funds, by virtue of mandate, have to be buying credit somewhere, whether it's high yield or a high quality corporate, in an effort to get some spread over that which they can earn in treasuries. And as a consequence, you have sort of a natural buyer for it, even if they have to hold their nose while they're doing it.
I'm nervous about pretty much everything. And, you know, there comes a point in most investment cycles where you've got to start thinking that the return on capital is rather less important than the return of capital. Just keeping your money, not losing anything, becomes more important.
A lot of the folks who are big names who maybe got it right at the beginning of this rally are beginning to say, hey, look, you know, this can't go on forever.
And one of those big names this week was Jeff Gundlach. He said in a Bloomberg interview, if you're waiting for the catalyst to show itself, you're going to be selling at a lower price. This is not the time period where you say, I can buy anything and not worry about the risk of it. The time to do that was 18 months ago.
Well, joining us now to discuss all the main issues in fixed income, Rachel Golder, co-head of Global High Yield and Bank Loan Team at Goldman Sachs Asset Management, and Craig Bishop. He's the lead strategist for U.S. fixed income strategies at RBC Wealth Management. And coming to us from St. Louis, Brian Rehling. He's co-head of Global Fixed Income Strategy at the Wells Fargo Investment Institute. I want to start, everybody, with a chart that basically shows what Jeff Gundlach is talking about. This chart shows spreads, basically the yellow line. We'll simplify it as option-adjusted spreads average, and then duration. And we can see duration really high, spreads compressing. So is the terror we heard in all those people's voices, is that justified by this sort of thing? Is Jeff Gundlach right, Rachel, to start pulling back?
Well, you know, we don't disagree. We think it's time to take risk down, and we at Goldman Sachs Asset Management have been taking risk down pretty steadily over the last couple of months. We're now actually targeting an underweight to risk assets, including high yield, investment grade, and emerging markets. But it's nuanced. We don't worry particularly about the current fundamentals of the market. Corporates are healthy, their leverage is pretty high, but it's not increasing. They've spent the last few years extending their maturity profile at very low cost of debt. We see a very low default rate, and we don't expect it to pick up soon. So the real question is, are you being adequately compensated for the volatility and illiquidity in the market? We think that we're facing a period where volatility could be higher. Seasonals matter. In the 4 months that we're entering right now, high yield tends to underperform, and we see triggers for volatility to go up.
And maybe it's for that reason, Brian, that you've been underweight high yield. How long have you been underweight high yield? In other words, how much performance have you had to give up as a result?
Yeah, when we look on a total portfolio basis, we've been underweight high yield since early this year, favoring equities for the risk-based assets. I agree with what everyone else has said. High yield looks expensive, but when everybody thinks the same thing, sometimes the opposite happens very easily. If everything goes as planned, inflation stays low, GDP improves, you can continue to clip coupon in the market. I just don't think clipping coupon is worth the risk you're taking.
Brian, what's your next move likely to be? Is it going to be to lighten up more or rebuild in high yield?
No, I think if we saw a pullback, we've seen a little one, but this is really nothing on the broader scale. If we saw a more meaningful pullback, we'd look to at least move back to an even weight position.
Craig, what is it that people are worried about? I mean, when you're looking at duration, you're looking at sensitivity to rate moves. what moves at this point?
Yeah, I mean, it's more of a question almost of what aren't investors watching and concerned about, because there's so much noise in the market right now. So, I mean, I think with regard to investors' concerns, specifically high yield, it kind of gets back to comments that have been made is, you know, am I getting adequately compensated for the risks I'm taking on? In many cases, I think the decision to move into high yield in search of yield, those decisions oftentimes are just made blindly. It's throwing money at the market to get better yield. So I think right now, to us, our caution tone to investors is really focusing on what you're investing in. Do you know what you're buying? I mean, do you know what your position is in high yield? Because we've looked at so many portfolios recently that over the last few years have chased yield in high yield, for example, and investors don't know oftentimes what their total exposure is. So it's really time to focus on what you own. Do you know what you own? Time to de-risk, actually.
Just because of the length of the expansion at this point? I mean, there's always a geopolitical risk out there that we can't quantify. But when you're talking about the normal sources of risk, like central banks, they're going out of their way to say, we are not going to move the markets. We're going to be very slow, very deliberate.
And we believe that. I mean, that's we believe certainly what the Fed is telling us. Our view is that you need to listen to the Fed, because I think despite concerns about whether or not the Fed's going to move in December based upon inflation, I think our view is that they will. They're talking about this gradual path. So clearly, to us, the expansion that we've seen, that we are currently in, has legs to go. I mean, we see no recession on the horizon. It's really 2 years down the road at the earliest in our book. If you look at the equity markets, certainly there's some volatility, and we expect a correction there. But equity and high yield pretty much, you know, moved hand in hand, and so I think there's room to run in high yield too. But it's time to be cautious also.
Rachel?
Yeah, we don't disagree that there's still plenty of time left in this economic cycle, but we also think that the Fed will hike at least once, probably at the end of this year, a couple of times in the next 12 months, and frankly that we're right on the brink of what we would term quantitative exit. So when we do see the Fed intending to begin to shrink its balance sheet starting at the end of September is our greater bet, that will begin to have a technical impact on the market. And in particular, we've seen very suppressed volatility for the last couple of years. We think volatility will pick up. High yield correlates highly with volatility. I actually have the Bloomberg chart here.
She's brought her own chart. She hashtag BTV 7356.
Right, and it shows a long-term history of very strong correlation between volatility and high-yield spreads. Now, just in the last 3 weeks, volatility has picked up a bit. High-yield spreads are actually already about 40 basis points wider, and there is a valuation question. People were really concerned about high yield when it was very, very tight. It's cheapening up now. There may be a moment to own it again, but it's a cautious period.
And of course, another chart that's really made the rounds this week, gotten a lot of attention, is one that shows how the European high yield spread has come down, down, down. The white line is the European high yield spread. The blue line is the 10-year yield. And in 2003, the European high yield spread came in below the 10-year yield. And you could see that it stayed that way for about 4 years. It took 4 years for that to change. It ended in late 2007. Now, if you go to the far right of the chart, we're on the cusp of the European high yield spread coming in below the 10-year yield again.
What is that telling us, Rachel?
Well, among other things, is an expectation that in Europe rates are going to lag U.S., that we're going to see a much slower path of quantitative exit in Europe. Also in Europe, you have in the high yield market a higher quality market. It's more of a double B market than a single B market. It doesn't have the energy exposure, which has added some volatility to U.S. high yield quite recently. It's a shorter duration market. It's only a 3 and a bit year duration market. So it's keying off very different things from the U.S. Treasury.
And Brian, what does that mean for you? Because you look at global fixed income securities. How does all the warnings about this credit cycle that we've heard from Jeff Gundlach, from PIMCO, what does that mean for Europe?
Well, we've seen obviously really strong gains there this year as spreads have tightened, but I think spreads can continue to stay relatively low. I mean, we're even weight overseas in emerging markets. That said, are you really being compensated for the risk you're taking? It's at best a wash. I don't think it's worth putting a lot of chips on the table there, but again, they are lagging the U.S. recovery, and so rates should stay relatively low and support that market.
All right, everyone stick with us. Rachel Golder from Goldman Sachs Asset Management, Craig Bishop from RBC Wealth Management, Brian Rehling joining us from St. Louis with the Wells Fargo Investment Institute. Now coming up, the auction block, Tesla sale of $1.5 billion in bonds causing a stir in the market. We'll go over all of it. From New York, this is Bloomberg Real Yield. I'm Scarlett Fu from New York. This is Bloomberg Real Yield. Let's take you now to the auction block. There were $62 billion in Treasury auctions this week. You had the sale of 3-year, 10-year, and 30-year debt. In the 30-year sale, indirect bidders took the second highest share on record, while in the 3-year, primary dealers took the second lowest share in the past 14 years. Now, on the corporate side, British American Tobacco selling $17.25 billion of bonds. That offering ranks second among this year's biggest offerings. Proceeds of the deal will refinance BAT's buyout of Reynolds American. And the debt sale that had everyone talking this week, Tesla, the company's inaugural junk bond issue priced at about 5%. The $1.5 billion sale of senior notes will again shore up its balance sheet as it ramps up production of the Model 3.
I want one.
We're
back with Rachel Golder from Goldman Sachs Asset Management, Craig Bishop from RBC Wealth Management, and Brian Rehling from the Wells Fargo Investment Institute. Since we're talking about high yield, Rachel, let me start with you. In terms of Tesla, I know you can't talk about the company itself and the bond sale that they just went to market with, but in general, does this reflect a strength of the market or a weakness of the market now? Are we seeing companies taking advantage of yields while they still can as the central banks raise rates, or is there just so much cash that anybody can bring anything to market anytime?
We will certainly acknowledge that this is an early stage company. They've got the big launch of the Model 3. It's 18 months out. They are collecting deposits for it now, but they are using this money to build the capacity to build that car. That's pretty venture-like in terms of use of proceeds. I wouldn't call it necessarily characteristic of the new issuance we've seen year to date. Yes, we had those two very large investment grade issues in the last couple of weeks, but actually the backlog of deals in the market is quite light. M&A is running well below the pace of 2016, 2015. Now, in terms of the Tesla financing, I guess the thing that jumps out at us is covenants are pretty challenging these days. We're not getting the same sort of protections that we did 15 years ago, but that's been a persistent trend over the post-financial crisis period.
Well, Brian, is that basically what you're seeing as well, that there is more fear in the market, so people are putting more protection into their contracts?
I would just say in general that the demand for debt out there is very strong. I don't see that fading. There have been some very large debt deals in recent weeks that were multiple times oversubscribed. And I think that trend continues, not just over the short term, but over the long term. There's some structural issues in the U.S. and around the globe that will persist, that will drive a demand for debt and duration.
Yeah, Craig, to pick up on that point, there have been a lot of large issuances. How has the market been able to absorb all of this without so much as a blink?
Right, well, it's a seller's market, and it's a seller's market. They can come to market with the cov-light deals. The demand just remains strong. I mean, the global markets are just awash in liquidity, and there's money that needs to be put to work, that wants to be put to work. The chase for yield or the reach for yield is still out there, despite warnings from Gundlach, Howard Marks, et cetera, about the kind of concerns right now. So it's a matter of liquidity, global liquidity, and demand remaining strong.
I'd like to add, though, that technicals are pretty strong in the market. We have seen record new issuance in the investment grade market, in the bank loan market year to date. But in bank loans and in high yield in particular, the use of proceeds has largely been refinancing, pushing those maturities further out into the future. Actually, post-financial crisis, we have not seen a resurgence of the LBO boom that we saw right beforehand. So the aggressiveness of issuance is not that exceptional. And actually, until this year, CCC issuance was actually quite light. Now there's some CCC, but it's mostly refinancing.
And Rachel, I know you were looking at bankruptcies in the picture there, and so far things don't look that terrible from that perspective.
Yeah, I'm going to say it's another chart I have up on my screen. It's only a last 12-month chart of the trend of bankruptcies. 12 months ago, we were dealing with the energy recession, and bankruptcies spiked to about 4% across the market. They're now down to below 2%. That's well below historical averages. You can see on the bottom part of the chart that energy dominates the largest liability stacks of the bankruptcy in the last year, but you have a couple of consumer products companies in there as well, Payless and Gymboree. That's an area of focus and concern, but it's a much smaller part of our market.
Does your, Craig, when you look ahead to 2018, do you worry about what we're going to see in terms of default rates, and does that change the way you look at things? I mean, we started the show with all those people talking about how worried they are about things right now. Are you anticipating any kind of spike?
We aren't. You know, I think it goes back to the current market environment. Slow global growth, low inflation, accommodative central banks. I mean, it gets back to the story about this. The markets have room to run yet, and so I think as long as we continue to see this slow and steady growth, you're not going to see this the pickup in defaults or bankruptcies. So, you know, high yield equity markets are going to be supportive, but it's just going to continue, in our view, to drive spreads a little bit tighter.
Brian, talk a little bit about the inflows that we've seen this summer. How has the amount of new money that's being put to work changed over the past 2 or 3 months?
Well, I just think you continue to see investors want to get into the market. We're starting for the first time in a long time, at least in the retail investor space, starting to see some investors move out of cash. We've had large cash balances. We're starting to see them invest, not so much in the fixed income markets, but more in the equity markets. Not a sign of frothiness yet, but that's a little bit of a change from anything we've seen over the last 6-7 years. So that's interesting.
Certainly is. All right, we'll follow up on that. Everyone's sticking with us once again. Rachel Golder of Goldman Sachs Asset Management, Craig Bishop of RBC Wealth Management, and Brian Rehling from the Wells Fargo Investment Institute in St. Louis. All right, let's get a quick market check on where bonds have been this year. Looking at the 10, 2, and 30-year, you can see yields all coming down, 1.29% for the 2-year yield right now. Still ahead, we've got the final spread. The week ahead features the minutes from the last FOMC. All that coming up. This is Bloomberg Real Yield. I'm Scarlett Fu. This is Bloomberg Real Yield. It's time now for the final spread. Coming up over the next week, you have U.S. retail sales, NAFTA discussions, missile defense talks in Washington, as well as minutes from the FOMC. And we're, of course, getting ever closer to the Jackson Hole meeting as well.
Interesting, Scarlett. We were just talking about whether assets are overvalued at all. Neil Kashkari, the Federal Reserve of Minneapolis Bank president, speaking now, and he says no asset class is flashing red to him. Craig, very quickly, anything the Fed doing worrying you?
No, not at all. Our view is we're very comfortable, and we've been very confident in the steps the Fed has taken to deal with the rescue from the Great Recession, as well as managing the recovery going forward. So looking at, you know, the upcoming FOMC meeting with regard to the balance sheet, we don't see a repeat of the taper tantrum, and then we still see the Fed rate hike coming in December.
Speaking of tantrums, I want to bring up a chart that and take you guys into the short end of the market, the very short end. Bills, #BTV 8582. This is the spread between 1-month and 3-month T-bill yields, and you can see the last 2 times we had a debt ceiling problem, we saw a spike below 0 for that spread, and we're not quite there yet all the way over on the right-hand side, but you can see us moving down. Let's start with Brian. Brian, are you concerned that we're going to have something happen in the debt ceiling debate that will cause the markets to react significantly?
No, I think the debt ceiling plays out as it has most of the other times. We go to the last minute, and they'll eventually pass. It will cause some market concerns in the near term, but eventually it'll pass, and it'll play out. I just don't see, they don't have any other choice than to pass it.
Rachel, is that too much complacency?
I'm not sure I'd call it complacent when you feel as though there will be brinksmanship right up to the last minute. We do expect volatility to pick up then, but I do think that everybody senses the underlying importance of clearing the debt ceiling. So it will happen, but it will be last minute, and there will be a flurry of volatility beforehand.
Craig, what will volatility look like this time around versus, say, the last debt ceiling debate?
Sure. I mean, I think given the uncertainty as to policy coming out of Washington right now, and who's kind of leading the way there, I think that will create the volatility. I mean, if you just look at, we went to the T-bill market. If you look at T-bills from late September into early October, you pick up 10 basis points already. So there's some concern already playing out in that market. We're not concerned. We think a debt ceiling will be passed. Supposedly, Ryan, McConnell, and the White House are all on board wanting to get a clean bill passed. So an uptick in volatility should be modest.
Brian, very quickly, you could also have the Fed starting its balance sheet reduction at the same time. Does that worry you that you have these two competing elements?
No, I'm not really worried about the balance sheet reduction impact on the market. I think it'll be very, very minimal. One, it's been well telegraphed. And number two, if you look at the Fed's maturity schedule, they actually have over $200 billion of extra maturing securities next year than they have this year. So they'll actually be buying more bonds next year than they bought this year, even though they start reducing the balance sheet. So very little worry there.
Doesn't that seem concerning that no one is worried about the balance sheet reduction? Just from a contrarian point of view, wouldn't that be reason to worry? Craig?
Yeah, I mean, I think that's a good point, and you're right to play the contrarian here. But I think what's different, say, than 2013 and the taper tantrum is that the Fed over the last few months has been so careful and cautious in kind of explaining what they want to do. So I think that's helped to pave the way for a reduction in volatility.
All right, it is now time to get to our rapid fire questions where you just have to give a one-word answer to our questions. First question here to Rachel. What will we be talking about in 5 years' time? Quantitative easing or, as you put it, quantitative exit?
In 5 years' time, we will probably be back on the easing side of it because I do think there will be a cycle between now and then.
Craig?
I think 5 years from now we'll be talking about interest rates lower for longer, little change from current levels, I think.
Brian, ease or exit?
Yeah, easing, yep, 5 years.
All right, very quickly, 4% Fed terminal rate stocks are overpriced, 2% they're overpriced, to 4% they're okay. What's the terminal rate?
Closer to 2 than 4.
2%.
And Brian?
Yeah, 2 to 2.5.
All right. Our thanks to everyone for joining us today. Rachel Golder from Goldman Sachs Asset Management, Craig Bishop from RBC Wealth Management, and Brian Rehling from the Wells Fargo Investment Institute. This is Bloomberg.